Good morning, everybody. You're listening to Money Matters. I'm Chris Hensley. It is 10 a.m. We've got a great show lined up for you today. Imagine a world where artificial intelligence isn't just a figment of our imagination, but a reality that intertwines with our daily lives. A world where the lines between man and machine blur and the digital realm becomes as tangible as the air that we breathe. This isn't just the plot of a sci-fi novel, but the world we're stepping into. Years ago, I delved into the pages of the book Neuromancer. That was back in middle school, right? A tale that painted a vivid picture of a future dominated by AI. Fast forward to today, and it's astonishing how much of that fiction has morphed into fact. But as we marvel at the advancements of AI, we must also ask, how's it reshaping the industries that have stood the test of time? Today, we dive deeply into the world of wealth management, a realm where AI is not just a tool, but a game changer. And I want to welcome today Ravi Koka, who is the CEO and the founder of StockSnips. Ravi, thank you so much for joining us this morning.
Thank you. Thank you for having me, Chris.
Absolutely, absolutely. Well, so let's dive right into it. Can you give the audience just a brief story into your personal connection or what motivated you for exploring this intersection of AI and wealth management?
Sure. Thanks, Chris, for having me on this show. Well, the story goes back almost more than 3 decades. When I came to the United States to, study computer science, and then I had the great opportunity of working with one of the leading lights in artificial intelligence, actually the person who invented the first speech recognition system. And that's what opened up my eyes, and I became very passionate about the use of artificial intelligence, especially natural language processing, because that's what is used for speech recognition. However, AI did not take off in the late 80s, 90s. It's called the AI winter, mainly because of lack of computing power and also the just the technology wasn't ready for prime time. Fast forward to today, you now have very powerful computers. Everyone's walking around with a supercomputer in their pocket, which is your smartphone. And also there's been a quantum leap in natural language processing, what is called large language models, popularized by ChatGPT, which was introduced by OpenAI. However, that's what I've been using for the last 5 years to derive sentiment by reading large amount of articles. So that's what I was very passionate about, is the intersection of AI and the world of investing, and that's where we are today with StockSnips.
I love it. Now, you mentioned quite a few things that we just to share with listeners. The idea that this is not a new idea. This has been around for a while, right? And you talk about the AI winter, the idea that there was kind of a pause between the 80s and the 90s and really kind of having stuff catch up, but that the large language models, this is stuff that you dealt with early on. And then the idea about sentiment, and I know, I've explored the StockSnips, and that's one of the things that you're using in there. So I will talk a little bit more about that because it's fascinating to me. AI is aimed at extending human cognitive ability. In the context of wealth management, how do you see AI addressing challenges and enhancing the advisor-client relationship?
So you're absolutely right. What AI is nothing but another tool that extends human cognitive ability, just like the human motor ability was extended by, like the airplane or the submarine, that allowed you to explore the oceans and the skies. So AI is going to allow humans to explore their cognitive things. You can do things that otherwise you would not be able to do, such as, for example, we are reading 100,000 articles a day and able to precisely find out what is being said about a particular company, which humanly not possible, right? Just how many articles can you read in a day and how much can you remember? This is where AI is very, very powerful. That's a particular use case. So in the case of wealth management, there are several areas where I see AI will get used. For starters, seeing the use of ChatGPT for things like communications, right? Organizing your emails or any other type of, for example, generating newsletters or doing some research that you want to share with your clients. This is called generative AI. That's the use of generative AI. However, the more advanced applications of AI, which is what we have been working on, is how do you pick stocks based on AI algorithms? So instead of a portfolio manager picking stocks, you can actually use AI algorithms that can be trained so that they can see how market conditions are changing, and you are able to pick in your portfolio the right stocks so that you are able to leverage the changing market conditions and the trends in the marketplace.
And that alone, I mean, that's amazing to me because, as an investment advisor, we look at, the headlines each and every day, but there's only so much that we can keep up with. And the idea you mentioned 100 articles a day that this is something that AI is really good at compared to human beings, I think. But even the idea of the sentiment indicator, can you tell us a little bit more about what that means as far as what sentiment is, in context with AI?
So the basic hypothesis is that stock prices for any of the equities, whether it's U.S. equities or global equities, it's not just driven by fundamentals. By fundamentals, we mean revenue, earnings, price momentum, things like that, right? So these are called fundamentals. There is the behavioral finance aspect of it, which says that stock prices react to human emotions, which is basically investor emotions. However, there wasn't a way to precisely measure investor emotion, right? That's what we came up with. We came up with a set of algorithms using natural language where we read the articles, pick the relevant facts in that article, attribute it to the right US equity, for example, and then also be able to say, is it what is being said, is it positive or negative? And then of course there's more data massaging you have to do, and you come up with a measure which is called the daily sentiment. That means that any time during the day for any of the 5,000 US equities, we were able to accurately measure and said, this is what the investor sentiment is. And we also then went ahead and statistically proved that investor sentiment is a lead indicator of price. Not 100% of the time, but majority of the time. So that's what investor sentiment is. That's what we're measuring, and it's all algorithmic. There's no human judgment here, in the sense once the models are trained, it's the AI algorithms that are coming up with the score, and then that score is used in constructing portfolios.
Nice. So I know, so I'm going to make my compliance people happy here, because anytime we talk about investing, I always want to say, we as an investment show that this is for educational purposes and not one specific system is going to be all things to all people. So always consult with a financial advisor before making financial decisions. With that being said, what you just talked about, human emotion, investment sentiment, these are very similar things to that equities people have looked at in the past as far as indicators and things. So this isn't that far out there as far as things that we use. In fact, I think if we have a litmus test of things we're looking at for investing in stock, the idea of sentiment is an important one to look at, however you use it. And then the idea that you guys are using it as a gauge. One of the things that you kind of do a ranking, and it's positive or negative, right? Tell us a little bit more about that, and then we'll get back to the bigger picture. But I'm so fascinated about StockSnips, I want to talk a little bit more about it. So.
Yeah, you're right. Sentiment is not new. In the old days, people would, in New York and Wall Street, people would get together in a coffee shop, talk about stocks and talk about what's going on and what are the trends, and talk about inflation, talk about something else. And that's how they used to make up their mind. And that is sentiment. That is one way of doing, gauging what people are feeling about a particular equity. What has become more sophisticated because there's been an explosion of information. In fact, IBM had a report that 90% of all of the information has been created in the last few years. So the question is, with this huge amount of information, including online media, social media, etc., how do you keep up with it? That's where the algorithms are much better than what a human can keep track of. The second thing is that how would you then there's more research, right? Just because you have sentiment, the other thing people look at, before I go on to what we do, is people also look at, for example, fund flows, how much funds are flowing into a particular stock, for example. Or people look at report on 13F filings or insider trades and so on. So what it does is these are all gauges of sentiment, but none of them are forward looking and they're not continuous. So those are the two important things. By looking at all the news captures a 360-degree view, because what you're capturing in the news is macro news. For example, what's going on in a war in Ukraine, or whether it's a rise in interest rates, or whether it's oil prices, and how that affects a particular stock, right? That is one type of news. The other type of news is specific to a company. How are the company's products doing? How are their global sales doing? Are they having any supply chain problems? So all of that type of information is coming in. When we talk about reading articles, we are picking up all of these things, both macro and micro indicators of how how something is going to impact the stock. So it's a 360-degree view. The second part is it's continuous. That means at every instant that is changing. It's not something 6 weeks ago or 10 weeks ago. If you look at fund flows, that's after the fact. You're going to get that information after for example, the regulatory reports have been filed, and you're going to get the information much later than it's not real time. So we are doing it real time. The second part of it, what you're saying is, how do you measure? So the measure is 0 to 100%. So when we say sentiment, we are translating into a score which is 0 to 100%. So Apple may be at 80% positive, Amazon may be at 70% positive, which means that Apple has from an investor sentiment perspective, has a higher score than, say, Amazon. However, there's another factor. How fast is sentiment changing, either positive or negative? For example, Amazon, in this case, Amazon may be lower, but if it is going up 10% in sentiment from 70 to 80, and Apple is going only from 80 to 82, that means Amazon has a higher sentiment momentum. So we take that also. So our ranking takes into account both the sentiment, which is 0 to 100, and also the rate of change in sentiment. Just like you measure change in price, what is called price momentum, we do sentiment momentum. And the way we arrived at these factors, there were several studies done by Wall Street equity research firms, academic studies, our own internal studies, that actually ran portfolios and measured against other indicators like RSI and price momentum and earnings revision estimates. These are, what typically are used by quantitative portfolio managers. And all these studies found that our signal was holding up well and was actually a good indicator of price behavior. And that's how we ended up where we are today, which is not only do we provide an investor sentiment signal for the 5,000 US equities, but we also went ahead and started to build portfolios which pick stocks from, whether it's from the Russell 1000 or the S&P 500, we pick the stocks that you should be holding within a given strategy.
So I can see where this, for advisors, this could help. I mean, it's no secret I use like a total return approach for my clients and their retirees, and so that's one of the things that we use as an active manager. But there's a whole slew of different tools that you can use, and this seems like just another one that you can put on there to give you good direction in that way, really. So I'm going to pivot for a moment, kind of go bigger picture here again, because you touched earlier about the idea that AI can free up advisors' time to make more personalized and impactful decisions. Can you elaborate on how AI tools can help advisors tailor their services to individual clients?
So, so this goes back to the big picture. If you look at the last decade, the what is called passive indexed investing. That means, basically these are systematic and they're tied to an index like an S&P 500, for example, the ticker SPY. So roughly 50% of all assets has moved to what is called passive index funds. So actively picking stocks and managing portfolios has become a real challenge. For example, a lot of advisors would have their own portfolios and they would use some algorithm, maybe a Dorsey Wright or some algorithm, right, which is a momentum algorithm. That has become extremely difficult because you're not able to outperform the passive index, right? If you are you able to beat the market? So with the result, what has happened is, there has been a lot of pressure on the fee structure as well as the time of the advisor. Are you going to sit there picking stocks and building portfolios and monitoring them? That's a lot of time. So that takes away time that you would otherwise be spending with financial planning, client relationship, advising your clients on how to meet their investment goals, etc. Right? So that's what an algorithmic, systematic AI-based approach in picking the stocks and managing the portfolio, as not necessarily as a core strategy, but as a satellites or sleeve strategy. You might still have the core strategy could be bonds, it could be a passive fund like an S&P 500 fund. However, if you want to capture alpha at times when the market, it's a bull market, then you don't want to lose out on that extra alpha because you want to do slightly better than what the market does. That's where you need an active strategy along with your core strategy, and an AI-based strategy, especially if it's systematic and low cost without any human bias. And obviously, it must have a track record and it should perform. That would relieve the advisor and spend more time on the client's requirements and his goals, and at the same time be able to manage the portfolio instead of just a standard 60-40. The 60-40 did not work very well in 2022. It went down 90, 18, 19%, right? So a lot of clients are saying, what have you done for me? How are you going to navigate when there's a bull market and when there's a bear market? And this is where active strategies have to be part of the mix, when you're building a broader set of asset classes for your clients.
I love it. I love it. This is all good stuff. Data is indeed crucial for AI applications. Could you explain how wealth management firms can effectively gather, process, and leverage data to deliver better financial advice and strategies?
I think the data part, there are more and more tools becoming available. I mean, almost whether it's Morningstar, whether it's any of the TAMP platforms that you use, you're going to see much more sophisticated analysis that AI is going to allow. Think of these as personalized co-pilots. So you think of every advisor walking around with a personalized co-pilot, which means that the type of data that it's going to alert you to is very specific to your clients and in their client portfolios, as opposed to, right now you get broad market information saying, oh, the market's going down because, something is happening and, the oil prices are going down, it's dragging the market down. That's useful, but that's not personalized. That's nothing specific to a person's portfolio. So that's where AI can be tailored, and you can actually personalize it so that, for example, if a particular portfolio has more exposure to certain sectors and something is going on in that sector, this will analyze the data and say, look, 40% of this person's portfolio is impacted by these sectoral shifts, so you better give notice, you give more attention to that, and maybe even do a rebalance, right? That might even trigger. You may sit down with your client and say, look, this is what's going on, and we better and maybe nothing happens. Maybe it's just a discussion, but the whole way in which you are dealing with clients and the amount of information you're using is going to dramatically increase, and you're going to look, in terms of your client, you're going to look, the value you're going to add is going to be much superior than broad brush newsletters and broad brush, market trends, which is what, a lot of the RIA firms do today, which is very difficult. For me as an individual investor, how am I going to figure out what all this means to me, to my portfolio? What should I do? That's what the client is asking, right? That's where I think personalization using AI copilots is going to help you.
I love it. I love it. I've actually in real life been doing a test case or a use case for this is for when we do review meetings. We've been doing for the virtual ones like this where you and me are talking live. I've added a company called Avoma where they do voice transcription for the meetings, but it's more than that because it brings in AI. So what happens is if I do a review meeting, at the end of that meeting, it's taking all of the dialogue and put it into a set of notes. And it's a real sharp set of notes because I've been able to kind of set it up for myself as a template. And it also, what we talked about earlier, the sentiment, that's the part that's amazing to me because it'll point out positive experiences in that meeting, negative experiences in the meeting. And it's a real time saver. I don't know if you see it, but I'm sitting here taking notes. Since I don't have it going right now, I'm an obsessive note taker, right? What it allows me to do is listen more. It really allows it, goes in there and it records it and that sort of stuff. So just what we were talking about, these time savers, these things that kind of like you mentioned, a co-pilot there. Let's shift and talk about, because we've only got a few minutes here before we hit the end of the show, talk about risk assessment. I consider myself a risk manager above all things. That's what, especially since my clients are retirees, that's what, and we're using active management, that's what they're hiring me for. Risk assessment is a critical aspect of wealth management. Can you delve into how AI technologies contribute to identifying and mitigating risk in an investment portfolio?
Right. So what AI has established or proven is that they can identify patterns that are not necessarily linear patterns, non-linear patterns, and also timeliness, right? The ability to go through large amounts of information in a short period of time. That's where risk management will start to leverage that, right? Because again, risk management at a very high level, risk management is, do I move into cash, or do I rebalance my portfolio to either increase or lower my equity exposure versus bonds versus cash? So that's the kind of risk management that an advisor does. And yes, there is help there also. For example, can you make that dynamic? Can you make that more adaptive? Instead of a fixed 60-40, can you, if it's a bull market and you want 70-30 or 80, how do you decide that, right? Obviously, there's a risk associated with it and a return associated with it. So AI can actually balance those types of, competing goals and say, look, on a risk-adjusted basis, we think, the allocation should be this. More importantly, the timeliness of the alert. An intelligent agent should be able to deliver an alert at the right time, at the right place, right? There's no point in delivering an alert after the fact. It's too late, right? And that's what happens with most of the risk stuff. By the time you react to something, it's too late. So it's a question here is the promise. Again, this is a lot of hard work and there's more work to do, but there will be sophisticated AI tools, risk management tools, which will become available that will allow you to be much faster in terms of your actions when some conditions are changing. And this is again a combination of specific information about a company or broad sectoral shifts that happen. So that's the promise. We're not there yet. Just to be clear, I don't know of a risk management tool that's going to be exactly right every time. However,
Right,
they're
right.
getting more and more sophisticated. The big guys like JP Morgan, they're beginning to use AI more in the risk management than, for example, generating alpha, because they're sitting on a large amount of data and they're using that to find patterns and be able to alert their clients and their advisors much sooner than otherwise.
All right. And so we've got about 4 minutes left, and I've got a biggie one for you. This one's important. It says, as AI plays an increasing role in finance, ethical and regulatory aspects become significant. What are some of the challenges wealth management professionals should anticipate in this regard?
Yes, there's a lot of debate. In fact, last night on 60 Minutes, Jeffrey Hinton, one of the fathers of modern AI, he was there talking about the potential problems of AI. He's the one who created this neural networks, which led to the creation of large language models and all the other type of models that you're seeing, ChatGPT and so on. And he was warning that these models could get so smart that they would get better than humans, right? So that's the one very high level risk. I don't think in the asset management world there's always going to be oversight. It's a regulatory industry. So I do think the SEC is going to step in and put guidelines. They already have. For example,
Right.
if you're going to use an AI model, I would ask the following questions, right? Just like you would ask of any portfolio, any new strategy. Who is the who are the people who created this strategy? What are their backgrounds? Are they ethical people? Are they people who have knowledge of this particular area? The second question is, what data are they using? The third one is, what are the algorithms? How have these algorithms been tested? Do they have experience with live trading, not just some back test, but have they proven themselves in live trading? So these are all, again, what I'm saying is not new. I'm pretty sure whenever you look at any new strategy, these are all the basic things that you would ask. So in that sense, an AI strategy is nothing but a more advanced quantitative strategy. So you would ask the same questions, and you would ask, saying, show me, show me what, explain to me all of these things, and then you can make your own judgment on, is this a risk that you're willing to take. One question people ask is, are we too late? The answer is no. You're absolutely not late. Is it the right time? I absolutely think it is the right time, because these are early days of AI. Whoever gets in, the early bird catches the worm, right? So whoever gets in and gets some experience under the belt will be able to serve their clients better than others. You need experience with picking an AI strategy, trying it out, seeing what the experience is. Then you're in a much better position as this AI wave starts to take off. Then you're not late to the game. This is the right time, I believe, to get in, because the technology has matured and there are more and more AI strategies becoming available.
Robbie, thank you so much. This is fascinating. I could sit here and talk to you about this for another half hour, but we are we are right here at the end of the show. For listeners who'd like to learn more about Robbie, Robbie, what's the best website for them to reach out to you at?
It's www.stocksnips.ai. I repeat,
Perfect.
www.stocksnips.ai. That will give you a lot of information about how we are using AI in the world of investing.
Is there anything I forgot to ask you that you'd like to share with listeners to leave them on a note here?
No, I think you did a pretty good job of covering all the way from the origins of AI to how it's impacting investing. So I think there's a lot to chew on here. So, and I'm happy
We did a
to
lot.
do another follow on if there's more interest. I'm happy to do a more deep dive and get into specifics of how a particular AI portfolio model performs.
I love it. I love it. Robbie, thank you so much. Have a good rest of the day there.
Thank you, Chris. Thank you very much for having, and thank you all for listening.